getting started. What's up, everybody out there? It's Mitch Goldberg. You're watching Be the Boss of Your Money. It's my live stream. We talk about personal finance, the market, the economy, the important things that you need to know. We've got a couple of things going on, but I want to tell you what the stock of the day is. Man, oh man, it's a big stock. And it is the stock of the day because so much is hinging on this one stock. Big mistake that investors make every bull market or every new bull market or between a bear and a bull. And what's the deal with interest rates? I think the Fed has done the right thing to raise rates. I think the Fed is about to make this into a really big mistake. And, I'm concerned about it. So let's just get into everything we need to talk about today. If you have any questions about what we're talking about now, about personal finance, money, investing, please hit me up in the comments. I love hearing from you. It's the best part about doing this. And while you're at it, if you don't mind, give me a thumbs up or a heart or an applause or a wow, depending on the reactions available to you, whichever social media platform you're watching on. So let's roll the intro, and we're going to have a good, quick show today, but it's going to be good. This is very important. I think it's one of the most important shows that I'm ever going to do. Here we go. All right, we're back. Thanks so much for joining me. Hey, I'm Mitch Goldberg. You're watching Be the Boss of Your Money. This is my live stream. We're talking about the economy, the market, personal finance, mistakes that investors make. We want to avoid some mistakes, right? I mean, learn from me. Take my mistakes. I've made plenty. I've also overcome many challenges in my life. So I have a lot to teach you. I'm old enough to say that now. I'm 55 years old. I've been in the industry for 32 years. I know a lot. I still have a lot of vitality before someone says, oh my God, this guy's over 50. I still can't believe sometimes. It's like when you hear about, a disease like COVID, you say, well, it's really bad for people over the age of 50. I'm like, I guess I'm okay. I have nothing to worry about. I'm like, wait a minute. I'm 55 years old. I have to worry about this stuff. But, it is what it is. It beats the alternative. And I must say, I'm living a good life. I've had ups and downs, don't get me wrong. But overall, I'm, moving forward, determined to be happy, loving this live stream. So join me. Ask me questions in the comments or just, hit me up with an emoji like a hi emoji or something or a smiley face in the comments. It helps with engagement, helps get the show out there, spreads the show to all of your contacts in social media land. And that's really important, okay? So what are we going to talk about today? First of all, what's this mistake that people are making? And I've seen this time and again. After every bull market, you have your leading stocks, right, in the previous bull market. And in this case, we know what they were. They were Facebook, which is now called Meta, Google, which is now called Alphabet. One of these days, I'm just going to call Facebook Meta, and I'm going to call Google Alphabet, and that's the end of it. I'm not ready to do that yet. I don't know why. And then you have Microsoft and Apple, Netflix, Nvidia. Excuse me, I'm sorry to sniffle in your ear, okay? And then we have Tesla. So, and what happens is the market goes down, we hit a bear market, and it happened exactly the way we've been talking about. I said, first, you're going to see it in the tertiary, third tier stocks. They're going to fall apart. And then the next thing to go are the second tier stocks. An example of a second tier stock, I would say, is like a lot of the pandemic stocks, like the Rokus of the world, or the some of the cloud stocks that you've heard of that that have come down a lot. A lot of the internet security stocks, software security. Okay, and then finally, the last ones, the biggest ones, hold up, and they even go higher, and they take the S&P 500 higher too, because these companies are so big, their market cap is so big that when they go up, they have a very big impact on the S&P 500 as opposed to little companies which are basically meaningless and they could disappear and it means nothing for the benchmark. By the way, you can't invest directly into the S&P 500 or any index, but you could invest in a security or stock that tracks or mimics the index. Okay, so it's just important to get that disclaimer out there. So, having said that, the market goes up because that speculative money has to find a place to go. So people start taking their last of their speculative money and they're throwing it into Apple, they're throwing it into Facebook, Meta, excuse me, they're throwing it into the big mega cap stocks. So if you're just looking at the benchmarks, it looks like the market's healthy. This is exactly what I said would happen. I'm putting my fishing pole out there for the compliment. I really said this. I said this, and I said this is exactly what happened in 2000. It's happening now, and it happened. Believe it or not, the stock market started to deteriorate over a year before the S&P 500 peaked. It's just that you didn't notice it by looking at the benchmark level or the level of the NASDAQ. So here we are. The big stocks finally rolled over, sending stocks down 25% or so from their all-time peak. Now, maybe 30%, so they're down maybe 20% from their all-time peaks. Okay, give or take a little bit. So what do we do now? So this is the mistake. Investors automatically assume for the market to go back up that they have to be in the same stocks, the leaders of the last bull market. So there is so much airtime given to should you buy Amazon or Apple or Nvidia, because so many people have those stocks and are down big in those stocks. I mean, I've spoken to a lot of boomers who are not my clients, and I have a lot of boomers who are my clients, and Gen Xers, people who have I'm saying boomers and Xers because that's the age of the population that has finally amassed $1 million plus net worth. Okay, if you're a millennial, you might not be there yet. You will keep trying. You don't give up. But the boomers certainly have, especially the type of boomer that's going to become my client. All right. So having said that, they're all in the same stocks. They're licking wounds. They thought they had all this money, and it turns out they are down 30, 40% from what they thought they had. And so much airtime, print time, media time is given to these same stocks, and people trying to figure out when they're going to bounce back, when they're going to go back up. And I find that it's a mistake to keep going back to the well, because every new bull market, in my experience, has new leadership, new leading stocks. And those stocks could be drug stocks, other areas of healthcare, bank stocks. It doesn't even have to be technology stocks. And that is a mistake that I see so many investors making. They keep putting more money into the same 4 or 5 stocks. And I don't think stocks continue to go down. I don't think stocks stop going down until investors have finally had enough. And it doesn't seem like they've had enough of the same 5 or 6 mega cap stocks. And something like $7 trillion of market cap in the S&P 500 has been wiped out by the drop in tech stocks, which is we've never seen anything like this in history. The year 2000 doesn't even come close to what we're seeing now in terms of the size of the losses. Now, if you're just an index investor, you're doing, you don't really notice it as much. You're down, but you're not totally killed. You're down. You're not down so much you can't recover, and you'll recover eventually, because the averages always come back, but individual stocks don't always recover. So that's like the big mistake I see people making, is they keep going back to the well. What's hard is knowing what the new leaders are going to be. I mean, that's the hardest thing. People will say to me, "Oh, then what are the new ones to buy?" If I knew that now, I would tell you. We won't know until after the fact. So do you want to take the risk of individual stocks? Or do you want to invest in a more broadly diversified way using exchange traded funds and mutual funds that mimic various indexes. And I have clients doing both. I have clients doing a mix of those two. I have clients just doing the index way or the individual stock way and a mix. Most of my clients are a mix. But this is part of the discussion, and it's not what I think you should do. It's what you think you should do. I just pull it out of you. I just help ask the right questions to draw the right conclusions to present to you a financial plan. Part of that plan is how we invest in the stock market. Okay, we've got a couple people out there. Let's take a look. What's the moment? Zoom went boom. Gotta hop. Keep rocking, buddy. Okay. I thank you very much, Carlos. You're probably not even watching the stream at this moment, but thank you for the for checking in. And I'll ask you later. I'll call you and say, what the hell are you talking about? You know, what the no, that's not it. No, that's not it. I don't know. I have a bleep, so I can't say the F word because I don't have my bleep button right now. All right. So the next thing is I want to talk to you about the stock of the day. All right. Let's take a look at the stock of the day. It's Apple. I know what you're thinking. It's not very creative, not very original. Ooh, wow, Apple. It's just the biggest company in the world, the biggest stock in the world, certainly anywhere. But so that's the stock of the day. Yes, it is. Because first of all, it's down quite a bit from its high of 182, now down to 141, getting to a level where people didn't think it could go. The other thing is so many people are relying on one stock, which has held up great until recently. And now even Apple is starting to crumble with the rest of the tech stocks. And it's down 20.5% year to date. Okay. But if we look at the, let's take a look, for example, at the S&P 500. How's that doing year to date? Just bear with me. I'll try not to give you a headache. Okay. The S&P is down 16.96% year to date. All right. So Apple's a stock of the day because it's doing worse than the overall market. It had been holding up. I remember recently it was only down 5% on the year and it was holding up great. And that's the one you want to own. This is the risk that people have of clinging on to the last bull market's winners. And I don't think it's a workable strategy. Maybe it's part of your strategy, but you know how retail investors they get overly excited and they decide that they could put more into it than they should have. So it's already like 6.5% of the S&P 500 market cap. So even if you're an index investor in the S&P 500, or even more if you're in the S&P 100 or NASDAQ 100, you already have a lot of Apple. So it's the stock of the day. Why? First of all, it's starting to break down. The chart's breaking down. We could get into that, but I want to tell you it is. It's going lower. I'm not saying it's going to go lower tomorrow, but it's been going lower. The way the chart looks, it looks lower to me, my opinion. They have massive China exposure, and who knew that who knew that Apple, which is the greatest at supply chain management, Tim Cook, their CEO, would have all of their manufacturing for their Pro models in one factory in China, which is basically shut down. They're going to lose about 12 million to 20 million unit sales, something over the near term, right before Christmas. And analysts are going to have to take down their numbers. Now, there's an asterisk. If you take down Apple's numbers, you could say asterisk. It's a blip because of geopolitical events, the COVID lockdowns in China, workers on strike. They'll get back on track. But when do they get back on track? Because they're expected to come out with a new model in about 9 months or so. They're going to announce it. So does that mean people won't buy the model that they missed now? So therefore, those are lost sales forever. And then what do they do? This is the issue. It's not going to hurt Apple so badly because it's not an inventory problem. Apple is not going to be left with excess inventory. the bane of technology companies is excess inventory because it really just becomes worthless so quickly. Like if Samsung has like millions and millions of phones in inventory in boxes in those little drawers at like the AT&T or Verizon store, you know what I mean? That shit becomes worthless really fast. Apple doesn't have that problem. Their problem is they don't have enough. That's a better problem than too much inventory. I do think that this whole COVID lockdown thing will get straightened out in China and Apple will be along its way. But in the meantime, do investors give Apple the benefit of the doubt, or do they say, I need to sell this? Because if they do, that puts the kibosh on the tech sector, which is the biggest part of the S&P 500. So that's what we're looking at. Howie's out there. Howie, baby. Excellent show today, Mitch. Thank you very much, man. I really appreciate that. Thank you, buddy. I'm really glad you're taking the time to watch it. So Howie coming in from LinkedIn. So totally like lost my my train of thought because my ADD just like kicks in so effing hard. Okay, I'm back on track. So that's why Apple's the stock of the day. But let's look at some important things here. And I'm going to tell you the most important thing of the day. It's not what we're looking at now. So the Dow is up 3 points. NASDAQ was off a little more than 0.5%. S&P was basically flat. Gold up a drop. Oil still under 80. The 10-year yield 3.7. It was 4.3 like 3 weeks ago. The VIX is down to 21. This was a super quiet day. There's nothing going on. I'll tell you why. Investors are waiting for tomorrow. Federal Reserve Chairman Jerome Powell talks tomorrow at the Brookings Institute. And investors are just like a glutton for punishment. They get excited and say, he's going to pause. He's going to pivot. He's going to, Fed's raising rates. When they stop raising rates, it means they pause on raising rates. That's the pause. And after the pause comes the pivot when they pivot and they decide to cut rates. And the pivot will look something like this. You just saw that. Your eyes do not deceive you. Okay. So that's what the pivot's going to look like. All right. It's going to be very tricky. It's tricky. It's tricky. I'm having fun. Look, if you don't have fun, that's too bad. I have to have fun. Okay. So anyway, let's take a look at crypto. Crypto's been holding up. I know it's been down, but Bitcoin went down to about the high 15,000 range. It's been hanging around 16. It dipped briefly to the 15s, but given the bankruptcy of FTX and the other one that just went under yesterday, not Binance, BlockFi, and the fallout from the crooks who were handling all of the crypto money in the world. I have to tell you, I actually think Bitcoin's been holding up really well. And there's another reason why Bitcoin's holding up well is because interest rates are starting to reverse. Now we're going to get into the most important thing, and this we're going to talk about for the rest of the show. Okay? It's this. These are the treasury yields. This is the yield curve of treasury bonds issued by the U.S. government. Okay? We still have 6 month at a 4.7, 1 year at a 4.7. Those are pretty damn good, decent yields for short-term money. I mean, I don't know why you'd buy a CD when you could get a T-bill. And not only that, but the T-bill, you don't pay state income tax on it. All right. Depending on which state you live in, that could be a really big deal. And T-bills are, I know you say CDs are safe and stable. T-bills are safer. Okay. T-bills are what CDs invest in. We got good yields here. We have very good yields. But the 10-year is at 3.8. I'm sorry, 3.7. Okay. So this is what I want to talk to you about. This is the heart of the matter. We're seeing a lot of things, and I think we're seeing some new things. Here's what I meant in the title of the show. Feds could be making a mistake. All right. If we get another big shutdown in China, which it looks like we're having it now. Now, it's not a foregone conclusion. China could turn around and loosen up on their COVID restrictions. And we could get a massive, massive freaking railroad strike. I mean, those two things at the same time, that's killer. That's really bad for the economy. So if the Fed's raising rates to slow demand and bring down inflation, well, supply chain issues causes prices to go up. And then what happens is if you start to get worried about the railroad strike and shutdown in China's economy, not for everything, but for the goods that we buy, that we use here in America, it creates hoarding. And when people hoard it because they're worried about shortages, it makes prices go up. And then the Fed raises rates to try to get those prices down, but it doesn't have that effect. It just makes life more miserable and more expensive. And it makes people cut back on other things. I guess what I'm trying to say is there's two kinds of inflation. There's the inflation where the Fed prints, or central banks generally print too much money and causes the price of things to go up. So if a gallon of milk is $3 and the Federal Reserve prints doubles the money supply, well, then the money is worth half. So that means a gallon of milk is $6. That's inflation, monetary inflation. But if milk goes up because of, let's say, there's a really bad cattle disease and there's a shortage of milking cows, of Holsteins, for example, I'm just trying to show you like my extensive knowledge of the dairy industry by throwing in the word Holsteins. Member of my temple's last name is Holstein, but he doesn't look like a cow. Holstein, you get it? Oh, hold on a second. You get it? Is that a bad joke? Yeah, it was bad. So, but shortages, prices go up, but is that actually inflationary? Now, we had a lot of supply disruptions, and the Fed said inflation's transitory because of supply chain disruptions. But the Fed had also printed like $8 or $9 trillion of money. So you had both. But if we have another, now that rates are way up, if we have another bout of Chinese economy shutdown and a railroad strike, inflation is going to go through the roof. The roof. The roof is on fire. We don't need no water. Let the. You thought I was going to say that, right? You thought I was going to finish that? No, I can't. I can't do that. Where is that goddamn bleep button? Hold on. No. Oh yeah, here it is. Let the burn. You didn't hear that, right? You didn't hear the F word in there, right? So, okay. So that's where the mistake could be. I think that the interest rates going down and the inverted yield curve is telling you, and I've said this before. Remember months ago, I said we are already in a recession. It might not meet the perfect definition of recession, but we've been in one. I think we're in one, coming out, and not like your standard recession where we have massive unemployment, but a slowdown in certain parts of the economy. We certainly have the worries that go along with a recession, the insecurities, the economic anxieties that go with a recession. But we're so prepared for it, and we're so in the mode of we're going into a recession in 2023. 2023, it's going to hit. Don't be so sure. Regardless, if we do hit that, it's actually going to be, I think, good for the stock market because it gets the Federal Reserve to hit that pause and then to hit that pivot, cut rates. In the meantime, companies have reconfigured themselves. The weaker companies have gone out of business. The stronger companies, survival of the fittest, have gotten stronger. And those are the stocks we buy and we hold on to and we go into. That's my story. I'm sticking to it. I hope this was helpful. I think the Fed It's got a little left in it. It wants a saving face moment where they could say, we're not, the Fed has to raise rates because they're in a box that said they would, but they need some kind of victory to say, we did it, we calmed things down, and now we could pause. We could wait. I think they're about to get it. And I think either China or the railroad strike, if we have, the China economic shutdown or the railroad strike, possibly could give it to them. In fact, if we don't get those, then I think the Fed keeps tightening because the Fed no longer has its exit ramp in it to its tightening policy. All right. I'm going to get going. I greatly appreciate it. Ron, I see you out there. Thank you very much. Ron, this is for you. Well, not to your level, but you know what I mean. All right. Anyway, great to see you guys. I'll be back tomorrow. And I really just so greatly appreciate all of you taking the time. See you tomorrow.